Hello, and welcome to another episode of Just Jim. I'm Jim Luff with Aurora Payments and our sister company, Chosen Payments. I share educational information that helps all merchants with credit card processing by providing training, guidance, and advice. Aurora Payments is a full service merchant services provider. We're ranked among the top 10 merchant services providers in America. Today, I'm going to be sharing information about the difference between a merchant services provider and a payment services provider. If you're in business, you've likely heard the term credit card processor. If you accept credit cards in your business, you might use a merchant services provider or a payment services provider. The two are not the same, and there are pros and cons of using both. Let's explain the distinct differences between the two types of credit card processors. The generic term of credit card processor has become synonymous with getting money from your customer into your bank account through a credit card transaction. Some brand name examples of credit card processors are Chosen Payments, Aurora Payments, PayPal, Square, or Stripe. While all of these companies can facilitate a credit card transaction, they are not the same at all. Some are merchant services providers, such as Aurora Payments and Chosen Payments, while others are payment services providers, such as Square and PayPal. Merchant service providers, such as Aurora Payments and Chosen Payments, provide our merchants with a merchant account. When a card transaction is completed, funds from the transaction are deposited into the merchant account. A merchant account is a special type of bank account that funds from credit card and debit card transactions are deposited into. After your credit card processor coordinates with the card networks such as Visa or MasterCard and the bank issuer such as Capital One or Wells Fargo, and the transaction is cleared, the funds are deposited into this special account before being transferred to your business bank account. Payment service providers, or also known as PSPs, are also known as third party processors or aggregators. They specifically facilitate online payments, including credit cards, debit cards, cash cards, and e wallets. Rather than having a dedicated merchant account with a bank, PSPs act as an umbrella for all of the merchants they serve under one master merchant account with sub accounts for each of their merchants. PSPs also provide a fixed rate per transaction plus a transaction fee for each transaction completed. This might be okay for small businesses with small transactions, but can have a very negative effect on larger transactions or businesses. With Aurora Payment and our subsidiaries, we charge a fee called an interchange fee, and it's set by the card brand, and we mark it up a little for our services. As an example, a $1,000 transaction with Square will cost a merchant $26.10 to process, whereas the same transaction with a merchant services provider like us would likely be around $19. So, who benefits from a merchant account? If you require personalized customer service, negotiated fees, and scalability, a merchant services provider is what you need. If you have high sales volume or process a high number of transactions each day or month, a merchant services provider offers discounted fees based upon monthly sales volume. If you do business in a high risk industry that has higher than normal fraudulent transactions or chargebacks, you need a dedicated merchant account and a dedicated merchant account executive. PSPs generally do not work with high risk merchants. Merchant services providers can usually integrate with your point of sale system or popular accounting software packages such as QuickBooks. MSPs offer greater access to merchant support, assistance, and your dedicated account executive knows about your specific business and activity. Full service merchant services providers provide comprehensive solutions, including point of sale systems, ACH payments, recurring invoicing, merchant loans, instant financing for your customers, and other solutions that are tailored specifically for your business. Next, I'll share who benefits from a payment services provider. If you want to start accepting credit cards right away, a payment services provider is the fastest way to accept credit cards. Because PSPs combine several businesses into one large merchant account, the qualification process is easier, and you can usually begin accepting payments the same day that you applied. If you're just getting started in business and you have no significant credit history or have sales volume of less than $10,000 a month, a payment service provider would be best for you. Payment service providers generally have month to month options with no setup fees. But let me also share the cons of payment service providers. Because the merchant account ultimately belongs to the payment services provider, you're more likely to experience funds being held more often than you would with a merchant services provider. If the PSP believes that a transaction might go against the terms of service, they're going to hold your funds while they investigate. PSPs are also not a good option for high risk businesses with high rates of fraud or chargebacks, or if you sell products that are regulated by state or federal level, such as firearms or cannabis. If we've inspired you to see how we can serve you, it's worth reaching out to us for a chat. Our team is ready to place you on the right path to improvement. Give us a call today at 833-287-6722. That's 833-287-6722. And thank you for joining me on another episode of Just Jim. We look forward to seeing you back here for our next episode as well. Have a good day.